Hi everyone, welcome back to my commerce class. Today I have taken one more interesting concept on banking subject, that is monetary policy of RBI. What is monetary policy and how it functions? What are the different measures taken to control the credit creation in the economy or the money circulation of the economy? That's what we are going to discuss in this session. So this monetary policy or the monetary measures of RBI can be discussed for hours together, but from the point of examination, I want to simplify the concept. Okay, so monetary policy has a set of regulations to control supply of money in the economy. Okay, so monetary policy is nothing but a set of rules and regulations which have been framed by the RBI to have a control over the money circulation in the economy. Now, that's money circulation means the credit creation, the borrowings and the credit creation. Because the higher flow of money and the higher rate of credit creation may lead to inflation. To control the inflation and to have a control over the public liquidity, the purchasing power or the money circulation, what is there in the economy, the government has to take certain measures through the RBI, and these policies are called monetary policies and they are also called credit control techniques. Okay, so we have different kinds of credit control techniques which are being applied by the RBI to have a control over the credit creation or the money circulation or the public liquidity, to have a control over the inflation or the deflation what is there in the economy. Okay, so let us know what are the different methods of credit control. We also call them credit control tools or the credit control techniques or the measures of monetary policy. So broadly classified into quantitative methods and qualitative methods. Under the quantitative, we find bank rate policy, open market operations, the variation in cash reserve ratio, variation in security margins. Okay, and the qualitative methods, the control through directives, rationing of credit, moral cession, and direct action. These are the different tools or the measures, the techniques which are used by the RBI to have a control over the money circulation or the credit control in the economy, to have a control over the inflation. Let's understand one by one. So under the quantitative methods, we have bank rate policy. Bank rate policy represents the interest rate, okay, interest rate at which loans are granted. The rate of interest will be varied, that will be changed as and when required to have a control over the inflation. So when there is a high rate of circulation, money circulation in the economy, the government wants to increase the rate of interest so that the borrowing of funds from the bank will be reduced. So when the cash flow reduces, automatically the purchasing power controls, so that you can also have a control over the inflation in that way. So the change in bank rate definitely influence on the inflation rate of the economy. Open market operations, nothing but buying and selling of securities. Buying and selling of securities, which includes shares, debentures, equity, okay, even government securities and all. So when the government wants to keep control over the money circulation, government gives an option to buy the securities, government securities, whatever it may be infrastructure bonds also, that will be issued to the public, so that the public, the people who are interested to invest, they'll buy the shares, debentures or the infrastructure bonds, so that the money circulation comes down. So like that, they are going to control the inflation. Okay. And likewise, we have variation in cash reserve ratio. That's what we call CRR. And also we have SLR, statutory liquidity ratio. By making changes in the rate of cash reserve ratio, and statutory liquidity ratio, RBI can have a control over the money circulation, that's a credit creation in the economy. If the cash reserve ratio, the rate is increased, if it is increased, all banks supposed to keep more funds with the RBI. They have to keep more funds with the RBI so that the cash with the banks will be reduced, so that they cannot give much money in terms of loans to the public. In that way, they can have a control over the inflation. Okay. And we have one more, that's called variation in security margin. Whenever the banks provide loans and advances, they get some security. Security means any documents or any sort of assets as security to provide the loans. Okay, so maybe in terms of pledge or in terms of hypothecation, mortgage, whatever it may be. It may be gold or it may be any documents or whatever it may be. So when they get these documents or assets to provide the loans, they have to keep certain margin based on the value, market value of the property what they are taking to grant the loans. If they keep higher margin, okay, the higher margin reduces or squeeze the credit amount. Okay, that means you can't give much loan to the customers. So RBI increases this margin rate so that the banks can give only lower amount of credit to the customers. In that way, the money circulation can be controlled. Okay, so this vice versa will be done when they want to make higher money circulation in the economy. That's what we talk about, the quantitative methods. And we have qualitative methods. In the qualitative methods, it's only directions or suggestions, advices, some orders will be given by the RBIs. Okay, RBI will give certain circulars, orders and all notices will be given to the banks to follow certain instructions. So that's what we call through directives. Some directions, orders will be given, circulars will be given based on that. That means some directions, instructions will be given to the banks, and all banks should follow the same. These directions may be to control the credit creation, or it may be to expand the credit creation depending on the economic condition. These directions will be given by the RBI. And rationing of credit, that means there will be certain restrictions on certain kind of loan which are granted by the banks. That means only for certain sectors, only certain sectors are encouraged by the RBI, and certain sectors are discouraged. Like some ceiling limits will also be given. Based on that, a control over the credit creation can be done by the RBI. Moral sessions, the instructions or some advices will be given to the managers or the higher authorities of the banks who are taking the in charge of granting loans and advances or the credit creation. And sometimes the RBI has to take the direct action also for the banks which are not following the instructions or the directions properly to control the credit creation. Okay. So likewise, we have quantitative and qualitative methods by which the RBI is going to have a control over the credit creation in the economy. Okay, so there are many examples that we can discuss, but from the point of examination, I think this is enough. So I'll take a detailed explanation in the coming video. Okay, like, share and subscribe. See you.